Good morning, everybody. We seem to have the attendees rising rapidly, so I think we can make a start. I'm Peter Stevens, and on behalf of the TMA, I'm pleased to welcome you to this second seminar organised in conjunction with Colliers International. For those of you not familiar with the TMA, we are a global not-for-profit organisation with the most professionally diverse membership across the corporate restructuring, renewal and turnaround space. With nearly 10,000 members in 53 chapters, belonging to the TMA allows members to gain access to knowledge and expertise that is vital in dealing with the challenging times businesses now face. Before handing over to Nick from Colliers, who has done an excellent job in organising these events, I just wanted to mention our other corporate sponsors. In particular, I wanted to thank John Pye, our corporate sponsor, who has just renewed their sponsorship for another year. We really appreciate their commitment in these difficult economic times. They're a good example of the diverse nature of the members. They're an auctioneering firm that will deal with anything from stolen goods that the police hand over to them to return goods to big supermarkets. So real diverse, but also obviously helping in the turnaround space where stock needs to be shifted on. We also have a wide range of other supporters that are listed here who enable us to deliver ongoing value to all our members. Of course, there's always room for new supporters, and if you're interested in joining, do please visit our website. I'll talk to our business manager, Nairi McGill, who can explain things in more detail for you. With that, I will hand over to Nick to introduce today's speakers and take you through the rest of the webinar. Hope you find it interesting, and there will be a replay available afterwards as well if you have to drop out for any reason. With that, Nick, thank you. Over to you.
Thank you very much, Peter, and good morning, everybody. Thank you all for joining us this morning. Really pleased to have as many of you with us as we have. You've joined the second in our series of webinars, which we are hosting in partnership with the TMA, which are coming under the banner of Real Estate Restructuring Strategies Beyond COVID-19. For those of you that weren't able to join us a couple of weeks ago, the first in the series looked at hotels and hospitality and is still available on YouTube, having had about 500 or so views, I think, so far. So if you have any interest in the hotel or hospitality market, hospitality, should I say, passive or otherwise, I'd encourage you to go and log on and watch that webinar, as we had quite an interesting discussion. My name is Nick Hammond, and I'm the head of the advisory and restructuring team at Colliers in the UK. We provide real estate restructuring, turnaround and insolvency advice to lenders, investors, business management teams and practitioners, and we do that across all UK property sectors. So what that means is that we get to experience a wide range of projects which span a variety of sectors and locations, involving businesses of various shapes and sizes. So really the purpose of this webinar series is for us to take a closer focus on a selection of those market sectors. And today, we're going to be looking at the real estate construction industry and in particular, managing development risk. As I'm acutely aware in my position in restructuring and also as a receiver from time to time, that there are various stresses and strains that the construction industry is under at the moment, and that development sites in particular are experiencing and are likely to continue to experience in the weeks and the months ahead. So to discuss that in more detail, I'm really pleased to say that we're joined by a panel of experts this morning, including Colin Wood and Paul Harper, both directors in our project and building consultancy team. Colin has 20 years or so experience in the building surveying project management industry, focusing on cost consultancy. And he's going to be talking to us this morning about what's been happening in the construction industry recently, a little bit about construction costs, and also about contractor failure and how we can potentially mitigate that. Paul Harper focuses on project monitoring, so his clients are generally lenders. Paul will not be presenting this morning due to other commitments, but he is joining us for the Q&A later on. So please feel free to fire some questions about project monitoring and such towards Paul. We also have Ollie Shipman, who is a director in our valuation and advisory team. Ollie focuses on the residential development sector, so he'll be giving us his view in terms of what he's seeing from a valuation perspective and how he's factoring these various changes into the work that he's doing and what he's seeing in the market. And to supplement that, we also have James Burke, who's an associate director in our residential team, and again, James focuses on residential development. As when we set out to create this webinar, it wasn't actually focused on residential per se, but as the speaker lineup and the topics and the discussion has evolved, we've actually decided that we want to focus on residential because there's quite a lot of interesting things to talk about. And I'm really pleased to say that we also have an industry heavyweight with us this morning from the residential lending sector in the form of Ellis Sher, who is CEO and co-founder of Maslow Capital. Ellis will be talking to us in a little while about his perspective as a lender, what he's seeing and what he's expecting to come in, again, the weeks and the months ahead. So without further ado, I'd like to start the formal presentations by introducing Colin Wood. As I say, Colin has over 20 years experience in the project and building surveying arena, focusing on cost consultancy, and he's going to talk to us now about what he's seen in the construction industry in the recent months and what he sees coming up. So Colin, please, over to you.
Thank you for the introduction, Nick, and good morning, everybody. Yeah, as Nick said, my name is Colin Wood, and I'm a director now at our cost consultancy team. So I help lead the cost consultancy offer for the UK, which is part of our project and building consultancy team. So within that, we focus on project management, building surveying, and development monitoring. So we're very much on the coal face of actually what's going on live building sites and building projects at the moment. In terms of a rough agenda, so the three main things I want to cover in my slot today is really sort of looking at activity on construction sites and how COVID-19 has affected that, how it has also then impacted on construction pricing and construction costs, and then, as Nick said, looking at how potentially we can manage that risk, particularly with regards to contractor failure, sort of further down the line. I think before we get onto that, it's just important to set a little bit of market context, because I think undoubtedly the lockdown has created an unprecedented challenge for the construction industry. But I mean, construction has actually been under stress for quite some time now. So I mean, the Brexit referendum was sort of 4 years ago now. And that's created a number of challenges around sort of supply of materials and labour, but also sort of affected the pipeline of work through those the Brexit negotiations. Actually, what we saw, and if you compare construction to how that's performed against the rest of the economy, what you saw immediately sort of post the general election and sort of in the run up to the lockdown, construction actually performed pretty well. So we were starting to see the beginnings of a Boris bounce. So you can see there on the stats, construction output rose actually by 1.4% for that quarter, whereas the UK GDP as a whole was a sort of flat 0%. So yeah, performing relatively well. As we moved into March, obviously, construction activity shrunk significantly. So the latest stats coming out shows the sharpest decline in construction output for around 11 years. But I suppose different to other recessions, that reduction in output was mainly supply-led rather than demand-led. And the things that the government are looking to do have responded very quickly to the situation to help protect some jobs through obviously the furlough arrangements, which means if we end up with a V-shaped recession, then hopefully construction can come out of that sort of relatively unharmed. So if you look at the impact on construction sites generally, I think we look at it in two chunks. So first of all, there's the immediate lockdown sort of in March and April, and then there's sort of the general easing of conditions as constructors start to get to grips with things. So I think certainly during March, most of the sites that we were involved with around the UK immediately shut down. And as soon as the Prime Minister said that we should all work from home as far as possible, main contractors really struggled to get labour to site. I think as soon as it became apparent that the government weren't going to prohibit construction activity, and there was a lot of confusion at the time around whether construction classes as essential work or not, as soon as it became apparent that they weren't going to lock it down, then actually the labour started to come back to site, mainly because they obviously wanted to get paid and move projects forward. What we then saw was more of a challenge around supply of materials. So, certainly, if anyone like me tried to undertake any DIY projects during March and April, you'd know how difficult it is to get hold of things like timber and bricks and concrete, etc. As we then moved through into May, I think contractors started to get to grips with how they can manage, obviously, the social distancing restrictions, and then we're starting to see sites get to a good level of productivity. And I've heard figures around sort of 50–60% productivity, but certainly some of the research that I've been doing suggests that typically they're getting up to around 75 to 85% productivity, particularly in and around London. So how have they done that? And that's primarily around logistics planning. Oh, sorry, can we just go back a slide? It's primarily around logistics planning. Looking at travel to work arrangements, then introducing things like temperature check-in, site access arrangements, welfare facilities, etc. But also, trades have had to look at things like producing method statements that maintain the social distancing. But also, there's a health and safety part of that as well. So they've had to not only contend with the social distancing part, but also make sure that construction work can be carried out safely and that obviously workers aren't being put at harm. What they've also started to look at is shift patterns as well, and that's where we're starting to see the outputs get from sort of the 50–60% up to perhaps the 85%, is where they can work during evenings and weekends to actually increase productivity by extending the site hours. Obviously, all of that has had an impact on pricing. If productivity can't get back up to where it was, that's having a big impact on main contractors and the supply chain. So I think certainly the inflationary landscape has changed significantly. So me as a cost consultant, obviously we're seeing prices coming in all of the time. I would say at best that the pricing is volatile. So you're seeing sort of both the high end and the low end of the spectrum at the moment. And I think that's just due to a lot of complex factors at play, which we'll come on to on the next slide, actually, if we can move on to that one. I think that this slide here probably demonstrates the stresses that contractors and supply chain are under at the moment. So if you look at the deflationary pressures, obviously there is a reduction in demand, and that's both within the UK and overseas investment as well. There's deflationary pressure around realignment of the cost base, and if you look at perhaps labour prices and wage and salary costs over the last 5, 6, 7 years, that they've been consistently rising. So what we're starting to see now is perhaps a realignment of that cost base and that overhead reduction starting to, the savings start to be passed through to customers. The fall in oil price as well, whilst not having an immediate impact, it will start to flow through the supply chain. That not only affects logistics and moving materials around the UK, but also that the manufacturing process itself, particularly when you look at things like plastics and electronics, obviously rely on oil for that manufacturing process. The flip side to that coin, actually, there are a number of other inflationary pressures, and that's probably we're a little bit on the fence in terms of where this is going to go in terms of pricing, because we're certainly seeing a reduction in capability and capacity in the market. And if you've been following the news over the last few weeks, you'll see lots of stories around obviously job cuts, etc., and all of that is shrinking the capacity of the market and its ability to respond when we do come out of this lockdown. As I said, the productivity measures in place, that is reducing productivity on site. So all of that is flowing through to construction costs and actually making virtually projects more expensive. All of that is really starting to sort of flow through and have a big impact on supply chain solvency. So in construction, whilst obviously you read the headlines of the big main contractors that are suffering. Go back to a few years ago with Colliers, for example. Most of construction is actually made up of SMEs, and they are sort of much less able to deal with some of the burdens that they're now being asked to take on. Construction in 2019 actually had the highest number of company insolvencies out of any sector, including retail. And that was a combination of factors around, if you look at depreciation of sterling, that made import costs higher. Rising labour and material prices as well were impacting on that, which meant sort of a combination of factors that meant that there's a lot of stress in the supply chain. I think what we are predicting over probably the last quarter of this year, and probably more into 2021 actually, is we think that trend is likely to accelerate. So definitely the market will become more competitive. A lot of clients are deferring decision making on projects now. So as projects come to an end on site, certainly contractors are looking at worried about their order books into 2021. So we see a much more competitive landscape. They're also, contractors are carrying much more risk now as well. I mean, the COVID-19 crisis is a known event, so the force majeure clause in the contract no longer apply. And also the government is unlikely to enforce any sort of shutdown of construction activities. So the burden is on the contractor to manage that. When obviously there are a combination of, as you saw on the previous slides, of different factors that are affecting the pricing. So we think we see much more stress in that supply chain and the risk of insolvency increasing significantly. How can we, as a client team, I suppose, help manage this risk? So I think as clients and consultants, I think the process of planning and information gathering, there's going to have to be much more emphasis on that. We see it very much as a partnership with contractors and supply chains to try and help manage this risk out. So I think that's going to require contractors to be more open with their programs and critical path, and look at where the client team can help with that. But also I think there's much more due diligence going to be needed, not just of main contractors, but supply chain and key providers as well. So that might include things like health checks on in-flight projects, to look at things like the percentage of turnover that key suppliers and subcontractors which that project represents, and looking at the sort of the financial risk of the supply chain as we move down the tiers. I think also contractors are also starting to want to renegotiate terms on contracts that are currently under negotiation. We're seeing COVID-19 clauses starting to appear in amendments where contractors can actually look to recover time and cost. I think that's up for each client to debate, but I think certainly the contractor is probably the best place to manage that risk. So I think that needs to be thought about carefully. I think above all, they make sure that your contract terms are clear. I mean, you'd be surprised by the number of contracts and construction projects that I've been asked to sort of intervene on over the years, where you find that actually a lot of the source of the problem is the contracts aren't signed because you're working under letters of intent, or there's a lack of clarity on the terms. So I think I'd certainly recommend getting those contract terms nailed down as far as possible. And then my final point would be just to look beyond the lowest price. Contractors, as I said, are very worried about turnover going into 2021. So yeah, I think there'll be some very competitive bidding, and potentially bidding at below cost as well. There is a real cost for every construction project, and it's up to your professional team to get the right answer on that. So I think just be wary, as attractive as it might be to accept the lowest bid. That is only an entry price. So I think the more educated clients and professional teams would look beyond that and interrogate that to see where the potential risk is, because obviously we all want to see developments finished off. That is all from me. I will hand back to Nick.
Thank you, Colin. Appreciate your thoughts there. That's really interesting stuff. You finished on contractor insolvency, which is pretty poignant at the moment, and also you mentioned that there has, of course, been a degree of corporate restructuring already over the last couple of years or so in the large outsourcing and contractor sector. But in addition, I think we're seeing an increasing amount of the SME element of the market is coming under quite significant pressure, and I suspect that's probably going to continue for the months ahead. So what we're going to do now is hand over to Ollie Shipman to find out how he's factoring these sorts of things as and where he can do into his valuation work, but also what he's seeing from his clients, which are, I can tell you, predominantly lenders, including high street, private banks, investors, but also developers directly. Ollie has been with Colliers for over 12 years now, and his experience is both overseas and also domestic, particular experience in large single asset valuations, which predominantly are within prime central London locations and also the home counties, but has residential development experience more broadly as well. So Ollie, if you can now give us your thoughts, please.
Thank you, Nick, and also thank you, Colin, and obviously good morning to everyone listening in from home. As mentioned, I'm Ollie Shipman. I'm a director in our residential valuation department. I'm going to talk to you about how we as valuers, and like all stakeholders in the industry, are currently doing our best to try and navigate our way through a turbulent and ever-changing environment. But specifically, I want to highlight our observations from a valuation perspective and how these affect the decisions we make when running residual valuations on development land, but ultimately how this might impact you as lenders, investors, and participants in the market. I thought it'd be easiest to run through in chronological order and to discuss the changing market conditions throughout that time, and at each point the resulting impact on how we have approached the valuation process. I don't want to dwell too much on the past, but I think it's worth putting into context in this particular scenario. So I'd like you to cast your minds back to that distant memory of a pre-COVID environment, when the focus was on the election result and as Colin alluded to, a potential Boris bounce. I'm not sure we had time to see the full effects of that said bounce, but certainly there were some reasonable signs of early market improvements. I mean, for example, as I recall a certain central London residential agent noting that they'd actually had their best December on record at that time. And the sentiment was so strong that many lenders were actually asking us to consider increasing values based on strong sales evidence post-election, which is something we've generally not done for quite some time. But given the uptick in interest and activity, I think it was actually good reason to do so in some cases. And whilst, of course, this is all interesting to note, I'll explain why this is actually quite an important consideration later on. But obviously, all good things come to an end. And following the announcement that we'd enter lockdown on the 23rd of March, the markets for new deals simply stopped overnight. And of course, we were immediately flooded with calls from lenders, from borrowers, asking how values had changed. But the simple answer at the time was, like most, we had no idea. And as an industry, we'd been criticised in the past, and particularly during the previous financial crisis, for arbitrarily reducing values based on sentiment alone. Of course, anecdotal hearsay at the time would suggest the markets were down, but unlike any other point in history, deals could physically not take place. So how are we to say either way with any confidence? The government announced that buyers should put existing deals on hold, and some transactions obviously inevitably fell through. There were also reports of buyers trying to chip on prices, but generally vendors were resisting these. The result was that there was limited to no hard evidence of brand new deals reflecting the current market conditions at that time to suggest movements in values either way. Therefore, whilst it might have been prudent of us to simply reduce values across the board, rightly or wrongly, the industry took the stance to instead to base our opinions on the evidence that we did have from the early part of this year, which, as I said previously, was actually looking relatively healthy. But inevitably, the approach came with the material valuation uncertainty clause that I'm sure you're all now unfortunately acquainted with. So despite negative forecasts and the threat of a deep recession, we simply had no evidence to move on our GDVs. And if anything, there was still pressure to see them higher than where they were in November 2019. And there was also very little activity in land trading, with largely only pre-agreed deals taking place. Essentially, there was no evidence of new deals of any sort that had been marketed and agreed exclusively during the lockdown period. Therefore, with respect to residual valuations at the time, the only feasible changes to appraisal inputs were perhaps to pre-construction or construction periods to account for the fact that the planning process was likely to be extended, and also contractors would struggle to get back on site for some time. Also, where there was a likelihood of sales in the near future, we might have extended our marketing periods to account for the potential delays in the marketing and conveyancing processes. And as I said, as an industry, we were conscious not to arbitrarily reduce value based purely on sentiment, but we felt we needed to make some adjustments to account for the ongoing disruption, particularly to the planning and construction environment. The ultimate result of this was actually minimal changes to our reported residual land values. Whilst again there was limited actual transactions, we felt this approach was justified as there was evidence at the time of pre-COVID prices trying to be renegotiated on the basis that developers were anticipating delays in starting construction. So of course, to the middle of May, and Boris announces the property market needs to get back moving again. Construction is encouraged to restart, agents are asked to go back to work, and as valuations and surveys could now take place, the sales market started opening up again. Inevitably, the market saw some of those on-hold deals we talked about earlier fall through, but actually a healthy number proceeded, and perhaps more surprisingly, was that a large proportion of those were at the same prices agreed pre-lockdown. Therefore, the early signs were tentatively encouraging. And by way of example, I actually visited a number of development sites of a well-known house builder last week. Their respective on-site sales and marketing suites had just reopened. But the reality was they were running on skeleton staff, and viewings were under strict guidelines, and also by appointment only. Show homes also had to be sanitized after every single viewing. But despite the heavy restrictions, one site actually told me they'd actually negotiated 7 reservations in the first week since lockdown was eased, and also at similar prices. And encouragingly, this also seems to be a common theme across all the sites that Colliers are currently involved with. So whilst it appears values are seemingly being held in the short term, I think inevitably there will be pressure on the sales rates, not only due to wider financial implications, but simply the ongoing restrictions in the actual marketing process. And also we have to be mindful that there's probably been pent-up demand in the market that might not last longer term. And on those same sites I mentioned earlier, construction also had just restarted, and they were getting to grips with the social distancing. The main observation was that despite being back up and running, they were unfortunately all operating at reduced capacities, and some of which were well below with what Colin alluded to earlier. And this, coupled with shortages of materials, potential supply chain issues, would likely impact upon construction costs and particularly timeframes, and certainly in the short term. Therefore, with construction costs potentially going up, development timeframes being extended, and sales rates slowing, you would suggest there would have to be downward pressure on land values. Of course, the theory is one thing, but what are developers actually doing in the market? Well, James will no doubt cover this in more detail later. And of course, the evidence is still very thin, but I think it would seem in theory that might always not reflect the reality. Ultimately, developers have to keep building. Most land buyers would suggest they are now back in the market and looking for new opportunities, but perhaps their focus might have just shifted slightly. From what we understand, there is tangible demand out there for subject to planning deals, or where there are options for extended lead-in times to hopefully allow things to go back to some sort of normality prior to starting on site. And conversely, there is limited appetite for what we'd call oven-ready sites, where construction is set to start imminently for the opposite reasons. And as suggested, this is where we've seen the odd attempted chip in the market, as developers need to account for immediate risk on development timeframes. In terms of finance, I'm sure the members of our virtual audience would know better than me, but from the lenders and the brokers we speak with, we're not aware of any huge shifts in rates being offered, but perhaps a slight downward shift in the LTVs. But the majority have said they're being more selective on who they lend to and are picking the right deals for them. So the industry sees no real reason to make major changes to finance inputs at this stage. Therefore, as it stands, there is now at least a little evidence to make more informed decisions on our inputs, on our appraisals. But I think it's still fair to say our valuation approach is still very much on a case-by-case basis, and certainly one involving on a daily one. Generally speaking, GDVs seem to be relatively unchanged, as post-lockdown deals are now being agreed, but sales rates are perhaps slightly lower. For sites already under construction or those with a ticket, it would seem hard to suggest land values have not been impacted, as it would be prudent to extend development timeframes, increase construction costs or contingencies, and perhaps even profit levels. But again, there is limited evidence of actual deals on this basis, as landowners have largely opted to wait and see. Conversely, there are actually reasoned arguments for subject to planning sites or those with outline consents to have been far less impacted. A large national developer I spoke to only last week admitted they were being more cautious on sales projections and development costs, but were not making wholesale changes to their buying metrics for subject to planning deals. In fact, if they needed to be more cautious on costs, they were squeezing their profit margins to actually remain competitive. And actually, they even went as far as to say they expected increased competition in the short term to account for the pent-up demand during lockdown. Therefore, on land where construction doesn't need to start immediately, I think there's good reason to suggest input shouldn't move materially and that land prices would remain largely unaffected. So, in summary, I think it's fair to say we're monitoring the market and in turn our approach to valuation on a daily basis. It's probably hard to believe, but I don't think as valuers we've ever adapted so quickly to a changing environment. Evidence is also being more heavily scrutinised than ever before. And we ask ourselves if any deal at the moment can meet the RICS definition of market value and therefore be used as strong evidence. I mean, how many deals at the moment would tick the boxes of a true willing seller? And given the restrictions on the sales process, can any deal claim to have actually been, again, properly marketed? Whilst it's safe to say, though, as an industry, it's been taken very seriously. And unlike never before, the major firms meet regularly to discuss and scrutinise deals and to share thoughts on valuation approaches. And the RICS holds regular conference calls to update on guidance and valuation uncertainty. So if I can, in an attempt to summarise, if I were to ask myself if development land values have been impacted significantly, unfortunately, I'm going to cop out and say I would say it depends, and of course it's very site specific. I think it's probably still early to tell with any confidence either way, which is why the valuation uncertainty clause remains for now. But in terms of the future, personally, I can't see how this ultimately cannot impact negatively on land values in the short to medium term at least. But anecdotally, there do seem to be some signs of hope, and the evidence that we do have would not point to wholesale reductions in land prices. Ultimately, there is still demand for family housing and, of course, a shortfall in government targets. I think we might see land deals structured slightly differently, perhaps, maybe with less money down up front. So we need also to be alert to headline pricing when we scrutinise the evidence that we do have. And lastly, in terms of our advice to clients, I think it's probably not a lot different to what Colin alluded to earlier. Unfortunately, the uncertainty clause does remain for now, but we're also providing more robust sensitivity analysis to allow our lenders to better scenario plan. We're also helping clients analyse alternate exit strategies, including things like bulk purchase deals, private rented scenarios, and also affordable housing. And unfortunately, for those credit departments out there, I think it's certainly fair to say our reports have probably got considerably longer. Thank you.
Thanks, Ollie. That's interesting stuff. You've covered a lot of ground there, so I appreciate that. I know certainly that whilst Colliers and other professional services firms of our size are not necessarily rushing back to our office premises at the moment, although we're making preparations to do so, we're all very keen to get ourselves back onto site and back into the market in that way. So it's good to hear that you've been at the forefront of that as well. We're going to hand over now to James Burke to give us his thoughts in terms of a sort of value but open market sales and saleability perspective. But just before we do that briefly, I have been slightly remiss this morning as I've not reminded you, as I did on our previous webinar, forgive us, we don't have the polling questions plugged in today as we did the first time around, although they will make an appearance later in the series. There is the ability to ask questions via the Zoom platform, which if you're familiar with it or not, it's pretty straightforward. If you hover your cursor over somewhere around the bottom or the side of your window, you should see a Q&A icon, which will enable you to ask us questions. So please feel free to type anything specific or general in there, and we will come back to those in a little while, whether it's project building consultancy, what Colin has talked about, or the valuation piece, and of course we'll come to Ellis in a few moments. But before we do that, as I say, James Burke is an associate director in our residential development team, and he's going to give us his views now on what he's seeing in the marketplace from an availability and demand and supply perspective. So James, over to you.
Thank you, Nick, and good morning all. I'll be providing a short summary on the residential development transaction market within London and the South East, picking up on some of the key points that Ollie has just raised and relating that to our current market experience. I think initially over the start of the lockdown period, the majority of the PLC house builders put an immediate pause on land buying, furloughing the majority of land buying teams, and whilst they assessed the market and the impact of COVID-19. This resulted in a number of the house builders dropping notable transactions across London and the South East. However, the business of land buying, particularly for the house builders, now seems to be firmly back on the agenda, with the majority of the house builders reporting all staff returning from furlough and active land requirements. That said, since the easing of the lockdown, the primary focus for most developers is unconsented development sites that can be acquired either unconditionally or subject to planning. This allowing the purchaser time to obtain a suitable planning permission and for suitable time to have passed to provide perhaps more clarity on both the construction and sales markets. We've seen this appetite for development sites either on an unconditional basis without planning permission or on a subject to planning basis throughout the lockdown period, having continued to agree terms and exchange contracts during this time across sites of varying scale within the South East. There have been very few transactions reported of consented development sites over the lockdown period, as I think Ollie's already mentioned. Of those that have been reported, the majority were marketed and progressing through a sale negotiation prior to the lockdown period. We have been involved with several development sites with planning permission that have transacted during this period, however. These have been of a smaller nature, sub 60 units in size, and certainly more flexible deal terms were agreed. For example, exchanging on a 5% or less deposit with delayed completions towards the end of this year. Looking forward, we're expecting to see plenty of development sites, particularly those with planning permission, come to the market towards the end of the summer period, when it's hoped there is a continued easing of restrictions. Landowners have generally not been under pressure to sell and have, in most instances, opted to wait for further market certainty before taking sites with planning to market. Given the general market inertia over the past few months, it's expected that we won't see the more traditional summer holiday lull over the mid-July, August period, as many of the developers who had perhaps hit pause initially on land buying look to make up for lost time and fill their future pipeline quotas. To touch briefly on the new home sales market, I've discussed with the head of new homes at Colliers, who's confirmed that we began to see national house builders putting measures in place to allow them to return to site and places of work as best as possible with social distancing measures in place. And again, as sort of Ollie touched on before. Colliers are now fully functional on 2/3 of our new homes projects, with the final third to return in the coming week. We've seen a real positive return to the market across all schemes, with each scheme achieving new sales within the first week. This is further supported by conversations across the residential division with house builders reporting reservation numbers across their projects to be comparable to their pre-lockdown reservation numbers. Both have also confirmed that their pricing has remained resilient, with incentives again broadly the same as before the pandemic. The media have portrayed a big effect on prices over the coming months, but we've not seen any evidence to reflect this so far. What we've seen is a pent-up demand after lockdown, which has translated into strong inquiry levels, viewing numbers, offers and newly agreed sales across the board. The question will be, will levels of interest remain high after the initial first weeks of interest and sales within the new homes market? Thanks very much.
Thanks, James. Appreciate that. And I think that adds a nice flavour to what Ollie has spoken to us about and what we're going to do now, ladies and gentlemen. I'll just remind you quickly again of the Q&A function at the bottom of your panel. We're getting a few questions coming in now, which is good to see. So please keep them coming. Now, without further ado, as I said at the top of this schedule, we're really pleased today to be joined by Ellis Sher, who is the co-founder and CEO of Maslow Capital. Now, for those of you that don't know Ellis, he is a chartered accountant by trade, but has been working in the non-bank lending, structured credit and property finance markets for several years now, having set up Maslow Capital at the height of the global financial crisis. And since then, over the last 11 or so years, Maslow has established itself as a leading provider of development finance. And I also know that quite recently, they've set up a quite interesting new liquidity fund, which I'm sure Ellis will talk to us more about in a few moments, or perhaps when we revisit that in the Q&A. So without further ado, Ellis, be delighted to get your thoughts from a lender's perspective, please.
Sure, thanks, thanks Nick, and thanks to the TMA and Colliers for inviting me. I think when Nick referred to me being as a heavyweight, he was referring to my waistline, as I was reminded on a private message that I received as the call continued. So I'll give you a perspective of what we've seen as a lender. Things were going pretty well up to the lockdown, plenty of liquidity, plenty of market participants. And I concur with some of the comments that have been made by the Colliers team around direction of pricing. Valuations were buoyant, and I would say we were in a purple patch, or the commencement of a purple patch period. That's what it certainly felt like. COVID certainly hit us with a thump. It was quite immediate. It was quite drastic. And we had to adapt. We've got many sites across the country where we support supply chain payments, and we had to adapt our methodologies of verification for materials that were still being delivered to site to make sure that the supply chain was functioning, and that ultimately when sites got back to work, there would be materials for the developers to use, and so that we didn't lose time. So we adapted to make payments on delivery notes, invoices, photographs, etc., just to make sure that we didn't compound and make matters any worse. We certainly went from a period where 95% of our sites were closed, roll forward to the 20th of April, where 95% of our sites were open. And I again concur that with Colin, that we have seen around about 75 to 85% of our sites in terms of their capacity back at those levels. So I speak for ourselves. I would say a lot of the initial period of lockdown was spent looking over our shoulder to make sure that we had done things correctly, conducted file reviews of every single case, just to make sure the I's were dotted and the T's were crossed, and then started to look forward as to what we would anticipate the future landscape looking like. I think, having started in 2008, 2009, this time is very different. Our first deal that we ever conducted at Maslow was a loan to value of 5% and an interest rate of 15% in 2009. And today, I would say that's an interest rate of 5% and a loan to value of 60%. And that is really reflected by the mass liquidity that has that arrived in the market over the last decade and continues to be in the system. We do see a lot of lender activity during this time, a lot more lender activity than, of course, we saw when we started the business. There have been a lot more lending models that have come to market over the last decade. If you cast back to 2008-9, it was a market that was dominated by your mainstream banks, and today it is much more fragmented. There are a lot more balance sheets that are active. The kinds of capital that are made available to developers vary from your bulge bracket banks to challenger banks, those are your balance sheet deposit-taking institutions, to new forms of credit that cover open-ended fund, closed-ended funds, peer-to-peer securitizations, you name it. The sophistication, the variety of lending models is vast. And one of our playbooks here is that we think some of those funding models will come under pressure. Some of the funds will come to the end of their legal life. There will be investor redemption requests, and the inability or unwillingness for some funders who aren't necessarily deposit-taking institutions or evergreen funded to be able to fund developments to fruition. And I think borrowers will start to encounter the question of did they borrow money from the right party. So they can actually have a good underlying asset, but they will feel the pressure of some of the pain that their lenders are going through. And so that gave rise to us launching our loan book liquidity fund, which is a pot of capital that we have set aside from within our long-dated institutional mandates to make available to developers, to other lenders who are coming to the end of life of a fund structure or a cost to complete facility is required, to working with administrators or LPA receivers, where we can come in at a safe level within the capital stack to ensure that properties do get completed. I think there is a well understood that one doesn't expose a property to the market unless it is watertight and done to a good standard. And so often these are seen as sort of property protection loans to ensure that the GDV is maximized. So the loan book liquidity fund that we have is positioned to sort of complex cost to complete and liquidity events for, opportunities that arise because of the constraints in some of the funding models that we think will play out. Our experience so far is lots of conversations with people that perhaps we wouldn't ordinarily be speaking with, a lot of honesty actually in those conversations. I think people have put some of the ego aside and said, look, the situation is X, Y, Z. And so the conversations have been frank and candid. That all said, we have not seen wide range transactions. We think that is a Q3, Q4 event. We often describe internally this period as sort of suspended animation while we go through the expiry of the furlough program and get to grips with the reality of what we're going to be dealing with going forward. I think a house view there is a lot will depend on what the government does in their next stage of employment protection, whether or not they announce mass infrastructure and shovel-ready schemes in order to absorb some of the burden on the economy that will happen when the furlough scheme expires. That all said, we think that the government is all in. So we do look at that sort of positively. We think that the government will do whatever they have to do to support the economy and specifically housing. We've had fantastic interaction with some government agencies during this time, and it is evident that the government supports. I'll be very surprised if it wavers. We think that we will see some amendments to stamp duty, especially at the low end of the housing ladder. We think that we will see extension of Help to Buy and other government schemes to keep housing on track. So from that perspective, we do think that there is some underlying cushion. In terms of our experience with regards to what's happened to sort of leverage and pricing and how we have responded and how our peer group has responded, and here I'll speak about our normal flow business as opposed to the secondary business, which is this liquidity loan book. Pricing has generally moved around about 50 to 100 points is what we've seen in some of our wholesale funding lines. But the most dominant response has been a reduction in LTV. If pre-COVID levels were 65% loan to GDV, then post-COVID levels seem to be 55%, with 60% only being offered to the most robust borrowers where the lender has got a good level of past experience. So there is a flight to quality there in terms of those heightened LTVs. The mezzanine market, 75% with interest rolled up, used to be the pre-COVID limit. I would say we're seeing that down to 65, 70% now. So more equity is having to be found by developers in order to deliver their schemes. Certain balance sheets, I would say, have been very busy. I know that some of my colleagues on this call are from the challenger banks. I know that they have been extremely busy and have been a beneficiary of this, as have we, in circumstances where the funding is evergreen. So deposit-taking institutions or evergreen funds have benefited from new deal flow inquiries. A lot has to go through due diligence now, but I think it's been a busy time as developers have found the active capital that remains in this market. Just looking down at my notes, I think that, and conscious of time, that I think we're in for an important period to really see how sentiment comes through the next 3 months. All of our completions that we've seen in the post-COVID period have been due to sort of pre-COVID activity. So I think we are in an important test period to see what genuine transactions are happening at what price levels in sort of the new world. So I'll stop there. Don't want to use up all of your morning. So Nick, over to you.
Ellis, thank you. That was fascinating. Really, really valuable stuff, and it's interesting to get your insight as through the eyes of a lender. So we've got about 10 or perhaps 15 minutes or so now for Q&A, ladies and gents. We've still got 200 or so participants on this call. So again, thank you all for joining and for staying with us. We've had several questions submitted. The Q&A remains open, so please feel free to keep those questions coming. And for the purposes of the Q&A, as I said at the top of this, we've also got on this call Paul Harper, who I will just briefly introduce. Paul, similarly to Colin, is a chartered building surveyor. He has around 20 years of experience in the project and building consultancy arena, having previously worked in Central Eastern Europe and set up a team over there, and since been back in London for 10 or so years now, I think, if my maths is correct. In particular, Paul focuses on project monitoring and has a number of lender clients. I'm sure he'll be able to give us his views on what he's seeing at the moment and what he expects to see. And with that in mind, but also bringing Colin into the discussion, perhaps we can start with one of the questions that was submitted as part of the registration information, which is from Angela at Principality. So Angela, thank you for your question. I hope that you're still with us. The question is, prior to the pandemic, there was a shortage of skilled trades and building material costs were on the constant march upwards. And we've had recent announcements from the likes of Travis Perkins that relate to closures or indeed downsizing of their staff, which is sad to see. So I'd be interested to get your view, Colin and Paul. What do you think the pandemic means in terms of the labour supply and material costs, both for smaller but also for larger national developers?
Shall I go first then? Well, I think the supply of skilled labour has really been a chronic issue for a number of years now. So, as we came out of the last recession, I think there was certainly a period of hyperinflation there, and although that has eased over the last few years, actually getting skilled trades, actually getting people through university or whatever, or through sort of the apprenticeship schemes, actually getting them in construction, it's been a constant challenge. So I think the risk is now, with obviously the redundancies that are happening and with companies not taking in graduates, and I think you will see a skill shortage at some point as those people don't come through the industry. So I think coming out of this, I think if it's a V-shaped recession as some are predicting, then sort of hopefully the furlough arrangements can fill that demand as we're coming out of it. But I think if it's more of a U-shaped or an L-shaped recession, then yes, certainly we will see some of those skilled labour trades and people falling out of the market. So I think costs will undoubtedly rise.
Yeah, just to add to that, I think that's absolutely right. And prior to the pandemic, those skilled trades were being filled by perhaps trades from outside the UK. With the Brexit taking place, obviously that's going to be harder to fill. And we were seeing pulled in from outside the European zone, which of course with the pandemic has affected movement, people travelling into the UK to be able to work on construction sites. So there's a short-term issue and there's a longer-term issue with perhaps Brexit being the sort of the one that's looming over our heads now.
Thanks, gents. And I mean, Ollie, is there anything that you can add to that in terms of maybe the impact on valuations? Perhaps it's obvious that those inputs are going to need to be reflected, but do you feel, or perhaps James, from a underlying residual land value perspective, do you feel that those increases are going to start to test the underlying viability of certain developments, including those that perhaps are already underway?
I think so, yes. And I think it's probably important to say that we're not here to sort of set the market. We just reflect what's going on from a valuation point of view. And obviously, it's been alluded to, there's lots of inflationary, deflationary pressures on costs and labour. And I think from our point of view, it takes time to pan out. But of course, we have to reflect the most recent costs and timeframes that are available to us from a valuation point of view. So we will obviously engage with the likes of Colin and Paul to sort of get a bit better indication as to where they are currently and where they might move to. But from our point of view, again, we just reflect what is out there at that time, at the valuation date. But I think on top of that, we'd obviously, as I suggested earlier, we'd be looking to potentially increase contingencies in our appraisals to account for any unexpected costs, and also run added sensitivity analysis for banks to help them analyse the situation.
Thanks, Ollie. James, is there anything that you would add to that?
I mean, I just think, as Ollie said, at the moment we're monitoring and we're reviewing what's happening in the market. It's difficult to say what the impact's going to be on how developers are buying sites and their interest. I think that there will inevitably be some, there is going to be a cost at some stage, and I think it'll just be how developers take that on board. As Ollie mentioned earlier on in the presentation, I think he said that they're looking at reducing their margins slightly to remain competitive. Whether that remains the case, I suppose we'll have to wait and see, and it will really be down to how much of an impact how much of a rise the construction costs go up by, I think. So I suppose it's wait and see at this moment in time, which probably isn't overly helpful, but it's sort of where we are.
Well, that's where we are, and perhaps Ellis, to bring you into that, if there are scenarios that come to pass whereby a project has stalled or been delayed for whatever reason, and it has to be repriced through to completion, and the costs are more than were originally envisaged, and there's either a lack of appetite or a lack of ability to actually fund it through. Is that an area where you sort of expect to see some activity in the funding market?
Usually, I mean, it depends on the extent of any cost to complete increases. Most lenders have sufficient retention or contingencies in their budget, so it would have to be quite extreme, I think, for a wholesale refinance. Generally speaking, the liquidity loan book fund is designed to step into projects where the contractor has become insolvent, and there needs to be a wholesale replacement and sometimes a retender. And at that stage, the costs will go up because the retender is usually, 10-15% higher than what the original underwritten costs were. So I think that if the increases are marginal, a few percent here and there, it's generally been picked up in tandem between lender, equity provider, or mezzanine. Okay,
thank you for that. We've still got 170 or so participants on this call, so we'll keep going for now. I think there's a few more questions to get through. Perhaps another one for our project and building consultancy colleagues. I'm not sure who this has come from in the Q&A submitted anonymously, but thank you nonetheless. Due to the economic climate, some PM/QS consultants are now recommending single stage competitive design and build tendering, which perhaps could be a rise to the bottom. What is your view on that, guys? Colin, you talked about looking beyond price earlier, so is there anything you'd add to that?
Yeah, sure. I mean, there's nothing wrong with single stage design and building. It's been around for a number of years, and it's a perfectly acceptable way of procuring a project. I think it's only a race to the bottom. As I said, if you accept the lowest price, I think the skill of your PM and your QS is actually probably knowing what the true cost of the project is. But it's also things like I mentioned about sort of interrogating supply chain. And bringing the suppliers into the discussion. So actually, through that sort of market engagement and market testing, as you move through sort of the early design phases, whatever you get back from that tender process won't be a surprise, because you've done that engagement. But I mean, it will be a buyer's market for at least in the short term. So I'd say that there's nothing wrong with a single stage DMB, but I think just definitely go into it with your eyes open and make sure obviously you've done that due diligence before you do accept a bid.
Okay, thanks, Colin. I'm going to just counter on quickly, if I may. A question here from Michelle. Thanks, Michelle. Do you feel the market is somewhat positively impacted at present by the immediate post-lockdown euphoria? Although we've got the as yet unseen but expected negative implications for the employment market more generally, as the government support initiatives we start to get weaned off of those. So how do we think the market overall will react in terms of those redundancies and those other post-COVID impacts? Perhaps, James, from your view in terms of demand and affordability, you talked about help to buy. I know there's been a number of citations of help to buy in terms of whether it's actually increased supply and affordability, or actually just pushed up pricing and profits. But those sorts of things, how do you feel that the actual buyer's market is going to be performing in the months ahead?
Thanks, Nick. Yeah, I mean, I think as we have sort of covered on this, there is going to be an initial bounce. I think a lot of the house builders are looking long-term. Development is over a much longer time horizon than, especially where planning isn't in place. And I think a lot of the developers are looking for longer-term projects. That said, they still do have requirements to deliver product, and that's going to be focused on more affordable schemes, perhaps less risky schemes as well, that are housing-led rather than flatted. And again, that's just managing that potential construction risks and costs that come with doing high-rise projects in denser, more urban locations. So I think perhaps there'll be and to be fair, there seemingly is already a bit of a leaning towards housing-led schemes over flats. But I think it really comes down to affordability of the units, and certainly from a new home sales perspective, help to buy has been well documented as being a bit of a support to the sales market, and I think that will continue to be so moving forwards.
Okay, thanks, James. I'm sure we could talk much further about the housing and occupier market more broadly. I mean, I was going to ask a question myself about build to rent versus private rent versus traditional housing, but I'm mindful that we'll try and keep to the title of this seminar, which is really real estate construction and the development side of things. So maybe we can revisit that another time. And Ollie, there's a pretty direct question here for you. When do you expect we might see the removal of the material valuation uncertainty clause from Martin Pollock at Hallcroft Advisory?
Very good question, and one I'd love to know the answer to. But thanks for the question, Martin. I think we're probably looking at two elements here, possibly the existing sales market and obviously the residential development market. It's safe to say that both are being analysed probably hourly, and the RSS are discussing that. But it's and it also has implications on our insurers as well. So it is being looked at. From my point of view, in order for the uncertainty clause to be lifted, you need a sustained period of transactions that show a trend rather than a one-off, of transactions that meet that definition of market value. So the key ones are that, are knowledgeable and willing buyers, acted prudently without compulsion, and also there's been proper marketing. So we need to see all of those things happening and that trend taking place. I think as I said, for single assets, new homes and existing homes, I don't think we're a million miles away from there. That sort of pent-up demand we talked about during lockdown is actually, there are new deals and they've got to reflect the current environment. So there is transaction there at the moment. I think we're not a million miles off that being lifted. Earlier this week, we saw it sort of recommended for lifting on build to rent and also ground rents as well on the residential side. From a development perspective on land, I think we're probably a lot further away, unfortunately. Obviously, the GDVs and what I alluded to earlier is just one part of that piece, and obviously what Colin and Paul suggested in terms of costing. I think a lot needs to play out. You've got so many factors at play. You've got finance, you've got costs, you've got GDVs, and all of the things that make up an appraisal. I think a lot needs to happen, and as Ellis suggested, I think we're going to go through a period of sort of let's just see how this market pans out. So again, we need a sustained period of transactions to take place in the development market, and I think unfortunately we're probably a long way off that yet.
Okay, thanks, Ollie. I'm conscious of time. It's 11:36. We've still got 130 people on this call, but we'll maybe just ask two final questions and then come to Peter for some closing remarks. The first question is actually from Peter. Thank you for this. This is, I suppose, for the panel generally, but perhaps for the building consultancy chaps more specifically. Given the recent anniversary of Grenfell, obviously very sad, what impact do we think this will have, as there still seems to be a bit of an overhang, for want of a better word, of buildings that have not been rectified?
Shall I try and answer that? I think there's a lot yet.
Oh, Paul, I think you've just flipped onto mute there. There we go.
Yeah, sorry for that. Yeah, I think there's still a huge amount of work to do. There is a vast number of buildings that have, I think, yet to be inspected. And there's, in terms of the impact, clearly there's a number of factors that need to be taken into consideration. Obviously, inspections of buildings of that nature have been on hold during the pandemic due to the obvious reasons, really. I imagine they're starting to take place now, or measures are being put in place for those inspections to start back. But there's still a lot of work to do, and there's a lot that yet needs to be established before the true impact can be assessed, really. I say. I don't know, Colin, if you've had any direct involvement with that recently.
Not particularly, I'll say, but I think if you look at, I suppose it probably comes back to the point around sort of supply chain and sort of and market engagement. I think it's I was just struggling to find the right points on that. Really, I think it's that market engagement. I think when we are developing design proposals, I think if you look at what happened with Grenfell, certainly it's not just a design issue. I think it's a supply chain issue as well. So I think it just illustrates the point of just sort of knowing what you're going into on a contract, and knowing exactly what it is you're buying, and engaging the market in that process.
Yeah, I think there's a huge amount of work that's already been done on the new build side of it. I think obviously looking at the existing stock and the buildings that are already up and that have this problem, there's still a lot of work that's yet to do, really.
Okay, thanks, gents. Well, let's maybe just bring this to a close with one final question. I'm going to sort of fire this fairly directly at Ellis. I hope you don't mind. I was going to ask you myself, within the development lending space, do you expect over the next 6 to 12 months more or less liquidity, or indeed a bit of market consolidation? And we've had a question from Fabian at Commercial and Construction Capital, which sort of extends that really by asking, how have development finance lending parameters changed, and how do you think they might look over the course of the next year?
So I come back to the fact that I think there's a lot of liquidity and interest rates are low and going to stay low. And I think people are seeking yield. So I am confident that you will have a thriving lending environment. The terms of those loans, though, are another matter. I think sentiment is really going to play out. People who are involved in, construction lending of having to do a lot of guesswork at the minute, and they're setting loan to values in order to protect them against that guesswork. As we've spoken on this call, the amount of uncertainty on your construction solvencies, your costs, your costings, and your GDV. These are three key inputs into a lender's assessment. And as those assessments become tighter, I think that you could see, some sort of LTV contraction or risk premiums attached to lending as we get deeper into this. That would be my most likely view. That said, if the shock that we get when people come off furlough and the economy can absorb some of the carnage that is left behind, and certainly that the government is very proactive in, absorbing some of the pain and some of their support continues, then perhaps it won't be quite as extreme. But we are certainly bracing ourselves for, I think we must be realistic that there will be a diminution in scheme profitability and GDVs. And I would imagine that the lending market will adapt to that sentiment if it is shared. But in terms of its availability, I do think that the liquidity that is in the market will ensure that there is a fair degree of developer choice as to where they can go and get their funding from.
Okay, thanks, Ellis, and thank you again for your input more generally today. It's really appreciated. Ladies and gents, it's now just past 11:40, so I think we're going to bring this to a close, but really grateful to you all for joining. We've still got 100 or so people on this call, down from 220 or so a little bit earlier on, so thanks again for joining these webinars. Just to say very quickly before I hand over to Peter, just do make sure that you're following Colliers on various social channels in order to get updates in terms of the recordings of these webinars, and also the new events that we'll be bringing to you over the coming weeks. And finally, if I could just hand over to Peter at TMA for his closing address.
Thanks, Nick. I really appreciate that. Thank you to all the panelists. I appreciate you taking time out of what I'm sure are very busy schedules at the moment. We really do appreciate it, and hopefully, as I have, the attendees have all found this really interesting and valuable. So thank you. One last point for your diaries is the next webinar we've got planned is with Duff & Phelps. Details will be announced in the coming days. And we'll also, as Nick mentioned earlier, we've got 2 more scheduled with Colliers, and we're working out dates and attendees. So again, watch this space for those. There will be a recording of this posted in due course. So if you didn't manage to attend all, you can pick up then. So I would just say thank you to everyone for attending, for your time and attention, and have a good day. Thank you.